Hello, welcome back. We're going to take a look at WW International, more commonly known as Weight Watchers. This one is a severely beaten down stock. You will notice here that it used to be more than $100 at some point, and now is down to 10.68, trying to mimic GoPro, I guess, which had a similar move some years ago. Now you will see that the short interest of the stock is 8.67% right now, but it's actually down from what it used to be. It used to be around 30 or so. It never squeezed, but it's worthwhile knowing that it's actually going down. Now the outstanding shares are sitting at 70 million, and they used to go down at some point, but then again, in 2016 and on, Weight Watchers actually started to sell a few more shares, I guess trying to capitalize the fact that the price of the stock was higher, and so you will have been diluted a little bit here, not massively. I guess from here it is a lot from 2012 or 13. It used to be 55 million, so that's a lot till 17. But lately it has been just slowly issuing a few more shares, not too many though, which is at least good. Now, the next thing we're going to examine here is we're going to take a look at the income statement because we want to see what the company is doing financially. And at the very end, we're going to look at the DCF model in which we're trying to find the actual value the actual amount in dollars that we are willing to pay today for the company, for the stock really, in order to buy the shares. So let's take a little bit of a look here. The total revenues of the company are actually going down a little bit over here. From 2017, they're actually almost flat. That's not great. You like to see a company that's increasing revenues because it means that they can sell more product. So, when this gets squeezed down, that's not the best. The cost of revenue is normal, let's say, what you would expect here. And the gross profit is likewise similar to what the revenues are doing here, going a little bit down, up, a little bit down. And at the bottom line, the net income is sitting from 163 million back in 2017 to 50 million right now. So it's massively down from what it used to be. It has dropped a lot in the last 12 months. I guess people don't care about their weight while we're in the pandemic, maybe. And so let's take a look at the balance sheet now. You will see here that the total current assets of the company are increasing, but not much from 2017. So it's a very, very steady company in terms of its assets. And likewise, all the total assets really, which is the current and non-current, they're basically the same, like a small increase over from 2017 really, very, very, very small increase. And the liabilities of the company, the total liabilities are sitting at 2 billion, while the total assets are sitting at 1.5 billion. So they have more liabilities than assets. And that's a worrisome thing, really. And the total equity of the company here, you will see that's actually in the minus. And that's actually not good at all, because again, they have more liabilities than equity. Cash flow. The cash from operations is positive at least, but it used to be better in 2017 and 18. So the picture of this company is a company that was doing better in the previous years. It's actually doing worse lately. And that's not always a good sign. Most times it's not really a good sign. Cash from investing is almost flat, not much happening here. Cash from financing is likewise relatively flat, a little bit of debt repaid here, I'm assuming using stockholders' equity or so. A little bit of issuance of common stock, not much going on. But the free cash flow is actually positive. In 2017 it used to be 200 million. And now it's sitting at 130, so it's typically above $100 million, which is good to see. Now the multiples over here, you will notice that they are very, very low, as you would expect. The company has lost a lot of its stock value, and so the actual enterprise value compared to sales is actually very low here. It's almost points to a bargain at this price. So the solvency tab is the biggest problem, I think, here. Two problems really with the company: a lot of debt when you compare it to their equity, and declining revenues and declining profit really. So these two things can really kill a company. Yet there may always be a price that you're willing to pay just to take on some of that risk. And this is exactly what we are going to examine right now, because there is always a price to pay again, even if the company is declining a little bit, as long as they are making money and they are projected to keep on making money. There may be a little bit of a bargain price that you would be potentially willing to pay, and let's discover that price. First things first, we're gonna copy paste the free cash flow items over here, and also we're going to be using the, let me find it here, the outstanding shares, 17.02 million. And I have already pre-populated the model here with the cash flow and the outstanding shares in million, as you can see. And I'm gonna be using a discount rate, which is basically noting how much money I want to be making annually from my investment here. And I'm gonna go for 15% just because I'm taking a lot of risk owning this stock with declining revenues and a lot of debt. So if I'm about to buy it, I want to be making quite some out of it. So I'm gonna go with 15% here. Now the company's actually average free cash flow is in the negative, but I'm willing to give it a little bit of a leeway here. So I'm gonna go 5%. Let's just say that the company is gonna be doing a little bit better in the next few years. They did have some declining free cash flow for year 3, for instance, or year 4 here, and this is potentially problematic. But again, I'm gonna be willing to give it a conservative 5%, which I think the company can achieve in the next few years. And again, we're talking about 10 years here. The perpetual growth rate is gonna be 1%. We don't want to outpace the economy. Actually, I'm gonna give it 0% here, just because again there is more risk with this company. So I want to, let's just say that it has a perpetual growth rate of 0%, so it doesn't grow at all in perpetuity. And you will see here that the company's price per share to pay today after all these calculations is at $16.74, while the company is actually trading at $10.35, so it's actually less. And this points to a company that is very, very undervalued based on based on the free cash flow that they are making and the projections that we are making here. And even if I use a perpetual growth rate of minus 1%, then we're sitting at a similar value as well. And let's just say that the company grows 3% a year. Again, we're above the current stock price. Let's just say that the company is not growing at all. Again, we're above the current price of the company. Even if the company goes, let's say, minus 5%, it is now where we are actually approaching. We're actually a little bit more overvalued here, but we are now very close to 10.43, as you can see. So if the company, let's say, grows minus 3%, it's actually minus 4%, let's just say, declines basically 4% a year, then we are very, very close to the current price. I think the minus 3% is the best figure that resembles the current stock price, really, as you can see. And so if the company loses 3% free cash flow a year for the next 10 years and the perpetual growth rate is minus 1%, it's still fair valued. And so, and that also implies in the calculations that I'm going to be making 15% a year from all these projections in free cash flow per share, of course. And so in 10 years, I will be making 15% if the company grows minus 3 and the perpetual growth rate is minus 1, which is insanely conservative. It's actually very, very cautious, and I don't think it's going to be that low, frankly, for the company unless something goes really wrong for them. And if we wanted to make, let's say, 13%, which is the more fair value actually really here, and a company grows at 0%, for example, doesn't grow at all in the next 10 years, then we're still at $14, and currently the stock price is at 10. So we're looking at a company that is undervalued based on how much they're making. And so, although there is some risk here, and some considerable risk based on the debt that they're taking, I'd say that as long as the company continues doing well with the market and kind of starts increasing the revenues and going back to, their normal days, I suppose, then we could very, very easily see this stock skyrocket at some point. So I would be willing to buy a little bit of Weight Watchers, but be cautious about it myself. I would actually not buy too much. Maybe it would be, I don't know, maybe 1% of my portfolio, or maybe 0.5%, something of that sort. And I'm actually thinking about it because this again looks very, very undervalued. I don't know enough about the industry really, and it's a very, very competitive industry that changes trends every day. But Weight Watchers is a big name, and I know that in the US they have a lot of food that they're selling, also like frozen food and stuff. I have bought myself many times, and so I don't think that they're going anywhere anytime soon. So yeah, that's what I wanted to talk about in regards with Weight Watchers. Let me know what you think about the company, and if you enjoyed the video, please leave a like and subscribe, because that helps a lot. And you can also join our Discord channel. You can find a link in the description box below. In the meantime, take a look at this video that I made earlier. It's about Alibaba and its recent headwinds with China again. So thank you for watching this one. See you soon. Bye bye.